This is a man who never took a single course in investing, finance, business, accounting, or economics, yet somehow managed to become one of the greatest investors in the 21st century. Charlie Munger, he created his own investment fund between 1962 and 1975, where he achieved annual average returns of 19.8%, and he was key to the growth of Berkshire Hathaway, the now largest investment company in the world and the sixth largest entire company in the entire world. But he didn't do this through conventional textbook type investing. He carved his own path to making money in the market. For Munger, it never matters what other people think, he just thinks about the facts. So let's look at how to invest this year through the Munger approach to investing. Now, I would love to go ask Charlie, what is the best approach to invest in 2023? What stocks do you recommend? How should we go about investing? But I got a funny feeling that I won't have the opportunity to ask the 99-year-old genius these questions. The next best thing for me is looking at his current stocks that he owns and what he's said in the past about how to invest. Charlie Munger, he has two portfolios. One is his own personal portfolio, and second is the portfolio that he manages at the Daily Journal Corp. The Munger family portfolio, it only has 4 stocks: Berkshire Hathaway, Costco, Daily Journal, and Leilu's fund. The portfolio that he manages at the Daily Journal, it also only has 4 stocks: Bank of America 43%, Wells Fargo 38%, Alibaba 15%, and US Bank Corp 4%. The Munger approach is only to find a few good opportunities and then bet very big on them. He has repeatedly said that he finds it easier to focus on 4 assets where he has a high probability of getting it right than on 100.
I think the great lesson from the Mungers is you don't need all this damn diversification. That's plenty of. You're lucky if you've got 4 good assets. I think the finance professors and that sell the idea that perfect diversification is professional investment. If you're trying to do better than average, you're lucky if you have 4 things to buy. And to ask for 20 is really asking for egg in your beer.
What you'll notice about Munger is he doesn't play by the rulebook. In 2020, when Bitcoin was all of the hype, he hated it. When all investors flooded to Wall Street decades ago, he stayed away. When everyone is avoiding investing in China, he plows money there.
The reason that I invested in China is I could get so much better companies at so much lower prices, and I was willing to take a little political risk to get into the better companies at the lower prices. Other people might reach the opposite conclusion.
He has 2 big investments in China. One is his holdings with Leilu, aka the Chinese Warren Buffett, a great value investor in Chinese stocks. And second is his position in Alibaba, the second biggest stock in China behind Tencent. This accounts for a decent percentage of his portfolio. He sees more positives than negatives with Chinese investments, a position which actually a lot of people disagree with.
And we find out recently that the Chinese have jumped the ship, and this is their last decade too.
So what is their plan on getting through what you think is a 10-year timeline for their demise?
Beat the nationalist drum so that when the food and the energy run out, everyone is banding together simply because they're Han Chinese.
That's it?
That's as good as it's going to get.
And even Warren Buffett, his longtime investing partner, prefers to just have his money in America and generally stays away from China. But Munger thinks that China, despite the communism, despite the political risk and all of the other risks, is still a good investment because at the end of the day, each year, they do get the results. They keep producing more goods, more services, and more profit, which is what an investor needs. Maybe something which is not as key is crypto, which Charlie Munger avoids like the plague. Buckle yourselves in because Munger will not mince words.
In my life, I try and avoid things that are stupid and evil and make me look bad in comparison with somebody else. And Bitcoin does all 3. and In the first place, it's stupid because it's very likely to go to zero. In the second place, it's evil because it undermines the Federal Reserve System and the national currency system, which we desperately need to maintain its integrity and government control and so on. And third, it makes us look foolish compared to the communist leader in China. He was smart enough to ban Bitcoin in China. And with all of our presumed advantages of civilization, we are a lot dumber than the communist leader in China.
Charlie Munger vastly prefers stocks to obviously crypto, but also basically any other asset class. Apart from the Munger family owning a few apartment houses, they just own stocks, whether it's China or the USA. And when Munger chooses these stocks, he has 4 simple rules that he goes through before buying.
We have to deal in things that we're capable of understanding, and then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple.
By the way, with rule number 4, that's exactly what I'm doing with the Investing Academy. You want to pay a price that makes sense, right? In order to do so, to know you're paying a price that makes sense, you need to know the intrinsic value. So with the Investing Academy, I release my calculations of the intrinsic value of different American stocks. You can join with the link in the description. But we all should be going through these 4 things, especially learning the value, before we purchase a stock this year. But some people do say, well, you should just invest your money in index funds. That's the easiest way to invest in, and you'll get fine results that way. But Munger prefers a different way to invest.
I'd be very unhappy if I had to own an index fund. My ambitions are larger. I don't think the average return of a skilled investor over the next 50 years is going to be as good after all factors as it was over the last 50 years. So I think reduced expectations are the best defense any investor has. And after that, I think Berkshire's a pretty good bet.
There is a danger with index funds. First of all, people just can't seem to stick to just buying, holding them, and not selling, and this is why the average investor gets so poor results. They don't have the temperament to own an index fund. And secondly, there are certain periods in the market where it is unprofitable to own an index fund. When prices are high, it can take a long time for index funds to produce results. Right now, we've experienced a small fall in prices, but even if you bought an index fund after a small fall in prices in 1930, it still would have taken 25 years to get your money back. Even if you bought after the small dip in 1969, it would have taken 24 years to get your money back. If you bought after the small dip in 2001, it would have taken 11 years to get your money back. Index funds can take time to produce results in certain periods of the market. Maybe, just maybe, like the one that we are in. The strategy that Munger has used throughout his whole investing life is buying good quality companies for reasonable prices. He developed this mental model as he learned and read and actually experienced real life investing. This strategy is so effective that he changed Warren Buffett's fundamental style to investing. Buffett, he used to only buy cheap companies. All he cared about was cheap discount stocks. But Munger convinced him that this is not the right way to go about investing for long-term investing results. Over time, if even you pay a bit more than what you wanted to, those good quality businesses will produce the most profit. And especially in times like these where the economy and the market has been shaky, Bad businesses will go out of business, but a good quality business will weather the storm.
We want to buy something that's intrinsically a very good business, meaning that an idiot could run it and it would do all right. And then we want that business, which an idiot could run successfully, to have a wonderful person in it running it. And if we have a wonderful business with a wonderful person running it, that really turns us on.
But even if you think it's a good business, but you don't fully understand it, then the answer is just leave it. Munger says, knowing what you don't know is more useful than being brilliant. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Analyze a lot of stocks just for fun. Analyze businesses throughout the year, but Munger teaches us that you only really need to pick one out of those 100. Most of those stocks you analyze, you probably won't understand fully, and that's fine. But what's important is you need to know that you don't know them. He says, I try to get rid of people who always confidently answer questions about which they don't have any real knowledge. Interesting fact, Jim Cramer made an incredible 21,653 stock picks in the last 7 years. Yet his own portfolio has underperformed the S&P 500 since its inception. Cramer doesn't truly know what he doesn't truly understand.
Just like Berkshire Hathaway or even the Daily Journal, we've done better than average. And now there's a question, why has that happened? And the answer is pretty simple. We tried to do less. We never had the illusion we could just hire a bunch of bright young people and they would know more than anybody about canned soup and aerospace and utilities and so on and so on and so on. We never had that dream. We never thought we could get really useful information on all subjects like Jen Cramer pretends to have.
Now, in 2022, stocks went down. Who knows what the heck will happen in 2023 and beyond. However, if stocks do go down, we know what Munger will be looking to do. And we know what most investors will do. These two parties will likely do the opposite. But Charlie Munger knows that it's actually a good thing to not do what the average investor does. He says, mimicking the herd invites regression to the mean. But Charlie does not want to be the mean. He wants to be above the mean. This is why you won't see him panicking or selling when stocks go down. He will be looking to buy.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in? No?
This is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets. So that the long-term holder has his quoted value of his stock go down and then by say 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get.
When investing, Munger is looking for what he calls a mispriced gamble. And if stocks go down in 2023 and beyond, then more mispriced gambles will come. He said a while ago that you're looking for a mispriced gamble. That is what investing is. And you have to know enough to know whether the gamble is mispriced. That's value investing. You should remember that good ideas are rare. When the odds are greatly in your favor, bet heavily. He did this when he found the genius investor Warren Buffett many years ago. He bet heavily there. He did this with Costco. He did this with Lei Lu's fund. And he's currently doing this with Chinese stocks. And you might say, well, a lot of what Charlie Munger talks about is simple. It's obvious. But what I say is, if it's simple and obvious and made him into a multi-billionaire, then who cares if it's simple if it works? Maybe we should all do the same. We should guard against the effects of hubris and boredom and just keep it simple when choosing investments.